Everyone, welcome back. It is very nice to be with you again. We have, of course, concluded our summer series. We will say gave fall a break, and here we are kicking things off for the end of the year with Austin Fitch joining us of Horizon Investments. Your designation is Chartered Financial Analyst, Austin, the highest designation available to a financial analyst of stocks and bonds and providing advice. And he is the head of practice management for Horizon Investments. Austin, always appreciate having you here. Get wonderful feedback. So now that we've started that way, say hello to everyone, please.
No, absolutely. Thanks for having me, Lou, and looking forward to the conversation as always. Love when we get into some of the deep dive topics. So let's do it.
Good. We'll do it. Yep. We'll take about 20 minutes for everyone watching, and I'll let everyone know that we are going to talk government shutdown. Today is government opening day. How do we
reopening? Yeah.
Reopening day. That's exactly right. Today is reopening day. So the government shutdown impact on the economy. We're going to talk pressure on the U.S. dollar outside borders, of course. Bonds, we always have to include some bonds in there, and then we're going to take a look forward to the end of the year. So, Austin, why don't we just kick it off? The government shutdown has formally ended today, November 13th. So everyone should get this within the week, and the data will be fresh. But please provide us with Horizon's instant analysis, if you will, which I think based on our conversation doesn't change a lot of analysis, but now just solidifies that. So please share with us your thinking.
No, I think you're absolutely right. I think the fact that we got the shutdown kind of out of the way actually paves the way for what we think is probably a pretty positive into the year. For anybody that had been paying close attention to markets and the economy during the shutdown, really the markets kind of took it as a non-event for the last 6 weeks. Our view, though, was that you were getting close to a tipping point when, like, you could realistically, if you hadn't gotten a solution this week or sometime here recently, you could have realistically headed all the way into 2026 with the government still shut down. And our view was if that would have happened, you absolutely would have had that start to weigh on consumers, weigh on investors, weigh on the markets. So the good news is we kind of avoided all that. Probably, again, to your question explicitly, it's going to end up feeling like a non-event. But like I said, we were getting close to it being a little bit more concerning and creating some volatility. So thankfully, that's not going to be a reason in our minds that you start to see any volatility heading into the end of the year.
Okay. And also, as it applies to the economy and some indication, the numbers, which we haven't had passed to us from the federal government, but numbers that we do have are consumer sentiment. And today, also a positive sign on consumer sentiment, correct?
Yeah.
What does that mean to everyone watching?
Yeah, I mean, I think what's surprising is that on the back of the government being shut down for 6 weeks is that you've had that positive reaction from a sentiment standpoint. I think the expectation was that you actually would have had more of a negative sentiment because of what we essentially just lived through. But in reality, it didn't really weigh on consumers nearly as much as folks thought. I think to your point about government data, the other benefit of the shutdown being over is now we're gonna get that data again. And one of the main data points that we've been watching pretty closely, even before the shutdown, is data associated with the labor market and how that affects the consumer, how that affects Main Street. Do you have an employed consumer? Do you have a labor force that's active? So I think that's going to be really telling as we head into the end of the year, what that labor market data continues to tell us. Because again, going back to the consumer sentiment being positive, actually at the core of it, like take the shutdown out of it, but the fact that you've got an employee base that is almost fully employed, basically, at this point, shouldn't be terribly surprising that sentiment isn't bad, like is actually halfway decent. Like, you don't have a bunch of people that are unemployed. You've got a pretty good base from an employment standpoint. So like they all kind of are intertwined together. And the fact that we're going to start to get that data again, I think is only going to be helpful in terms of clearing up any uncertainty that maybe otherwise would have existed.
All right, thank you for that. And I will say that going back a number of years, well, I mean, better than a number of, let's call it a decade plus.
Yeah.
I started communicating thoughts and ideas through video, through emails to clients like this. And when government shutdowns were coming, I would send those videos out, those comments out via email. And now I said, something this time, I don't want to do it. And that's not to say it isn't a big deal. It is a big deal. It's a very big deal. And so, of course, there are people behind that shutdown, people who are not getting paychecks. There's real impact to day-to-day people that is terribly unfortunate as politicians play politics. So it's not as though it's not important. Unfortunately, it does qualify now as, sorry for the idiom, parable, whatever you want to call it, as the boy who cried wolf just a few too many times. And that is, I'll say this to you, Austin, as a financial advisor and giving clients advice about things other than just investments. This is something that we will think through the next time there is a government shutdown, meaning we will not ignore it. We need to correctly communicate what it means to investors moving forward. If the news cycle has softened the impact, we need to not soften that impact.
No, you're absolutely right. And because we've now lived through, just in the last 10 years, multiple shutdowns of longer than 30 plus days. And we're kind of getting desensitized to it, to your point, which is not necessarily a good thing.
No, that is correct. All right. Now, the next topic that we had on our agenda, and for everyone, Austin and I have a quick conversation about this is what I'd like to talk about. And to his credit and Horizon's credit, they are ready for my conversations. The pressure on the US dollar against, let's say, the British pound, against the yuan, against the euro. Tell us, if you would, frame out why lowering the dollar's value against those currencies impacts the stock market, and what impact does it have on the stock market, please?
I mean, you've seen it. I wouldn't say dramatically. I don't want to over dramatize it, but I mean, you've seen a meaningful move weaker when it comes to the dollar over the last 18 months, maybe even 2 years at this point. And a lot of that has come even in the last 9, 10, 11 months with some of the uncertainty that surrounded the U.S. economy and the global nature of commerce, specifically with tariffs and Liberation Day. You saw uncertainty around what does that mean for the reserve currency around the world. As many people probably know, the US dollar is generally seen as the reserve currency. I think with some of the rhetoric that happened earlier this year, and for that matter is still happening when it comes to the tariff conversation, there's been some, I would say, rethinking of how many US dollars does China want to hold? Does Japan want to hold? Now, the caveat in all of this, Lou, is that there is not another currency that is anywhere near replacing the US dollar in terms of a global reserve currency, for reasons that we could fully unpack, and we could do a whole nother, hour on that. But I would just say, I don't think we're at risk of the dollar being replaced, but you do have more uncertainty leads to kind of that weakening of the US dollar. So what does that mean from a stock or a market standpoint? It means that international companies that are doing business outside of the US, maybe not as reliant on US dollars, actually have been more attractive than they otherwise would have been, is probably the best way to think about it. So one conversation we've had a lot internally is you've seen European stocks, for example, this year perform really, really well on a currency adjusted basis. Like if you incorporate the fact that you've seen the dollar weaken. Well, if you really unpack that, a lot of the performance that you've seen from some of those international markets, Europe, Japan, China, actually has predominantly come from the currency difference as opposed to fundamental strength of the companies in those countries. So like if you were to put two companies side by side, one, inside the US, one outside the US, on average, the fundamentals remain stronger for companies inside the US. This year, it hasn't played out exactly that way for US investors because of that currency adjustment and the uncertainty that's overhanging when it comes to the US dollar. You've seen many of those companies that do business in other currencies actually benefit from a strengthening, euro, strengthening pound, strengthening yuan, yen, which has helped them, but it's a little bit more of like gaming the system, if you will, as opposed to like, it's not like their business is like going gangbusters and is infinitely stronger than anything we could see in the US. It's actually US companies remain kind of the gem of the global economy, but the currency piece around the tariffs, around Liberation Day and those conversations has been an overhang on US companies around the world and has helped by default international companies that do business in currencies other than US dollars.
And that would include companies in the U.S. is called internet. What they are,
global or internationally diversified.
Right. Okay.
In the U.S. for sure.
Those global companies, U.S. based, have call it an advantage.
Yep.
Because they can convert or are just trading in
if they have offices in Europe, right? All of a sudden, you're going to hold more euros than you hold dollars, or
sure.
vice versa. Right.
And while you were speaking, I just thought I would do a calculation because I do keep an eye on the Great British Pound for reasons of let's say my other half being English. And just 6 months ago or so, 30,000 US dollars was 26,000 Great British Pounds. Yep. It is now 22,000 Great British Pounds. That's rough.
Meaningful move, right?
Without question, yeah, roughly 20%, and I think that's part of the administration's goal in their fiscal policy is to strengthen or to weaken the dollar, strengthen U.S. stocks almost in a reverse manner, if you will. So very interesting, very challenging as it applies to the U.S. dollar for those who purchase outside U.S. borders. Yep. And that has an impact, has a meaningful impact on us as we're talking about. Yep. The bond market. We always like to bring up the bond market. It has been a challenge. It remains a challenge. Has it stabilized at all? And if it has, what has stabilized it? What's the outlook on bonds, if you would?
Yeah. No, I mean, it's stabilized relative to where it was, 2 years ago. Absolutely. Sure. Again, that's a bit of a low bar in a year when you think back to 2022, 2023, when bonds were consistently down, 6, 8, 10% on an annualized basis. Like, yes, bonds are no longer negative in terms of what we're seeing. That being said, we don't believe, and you haven't seen it, that bonds are going to have some massive rally either. I mean, again, we don't need to go too far into the details of kind of bond math, but generally speaking, the way that the bond pricing works if interest rates are falling, typically bond prices are going up. And you've seen rates fall marginally, right? Fed start to cut rates earlier this year. They're doing so at kind of a measured pace. But honestly, a lot of that has already been priced in. Like, generally speaking, folks have a pretty good sense, and to their credit, the Fed has done a pretty good job of forecasting what their moves are going to look like. So the market market is a forecasting or forward-looking mechanism. So the market's kind of priced a lot of that in. I think our view from a bond standpoint in terms of what you should expect is, generally you should expect to receive, like, total return, you should expect to receive the yield or whatever interest payments you're going to get, plus maybe 1 or 2%. So if the yield on your bonds is 5, you're probably going to get a total return somewhere in the 6% range. If the yield drops to 4, total return in the 5% range, which again, very, very different, very much better than, a negative return by all means. But we don't want anybody expecting, hey, my bonds are going to return double digits, or I should expect a catch up in the bond market. It's just not, it's not set up to play out that way.
Well, and go back to the pressure on the US dollar. That's part of the
Yes.
equation.
Yep, for sure. Yep, 100%.
Weaken the dollar, you're going to weaken the value of the bond along with it.
Absolutely.
There's no, that safety valve, if you will, has been closed, and that's not exactly what we want for bonds. And I've had conversations with others and shared them with clients about the importance of bonds, tracking what insurance companies are doing with bonds. And this is actual data. Now it's one data point, but in the case of something I was looking at with an insurance company, they were paying 5.5% on a contract for a 5-year contract. But if you extended it 7 years, now normally you would expect the 7 years, the 7-year contract, not at 5.5%, but more like 6.25 or maybe even 1% more. It was actually lower. It was 4.25.
Yeah.
So that is a tell as to what the long end of the bond market looks like. Insurance companies know what they're doing as it applies to bonds. That's a conversation for another day, but it is important to understand their matching of assets and liabilities and how they do so. And bonds are the way they do it. So it would think very telling that 5.5 or that 5-year was a stronger interest rate than the 7-year. So anyway,
I think you're absolutely right.
Okay. Last but not least, let's look forward. You did this last time for us, and I won't give anyone the number. I will ask everyone to go back and find the video and watch the last 5 minutes of that when Austin Fitch managed to shock Lou Tranquilli, which is a difficult thing to do. But you're to date your comment on the outlook for the stock market. Based on a couple of qualifiers in there, was really strong. It was a good thought process looking forward without using, let's say, a return number. Not necessary. Give us the last 45 days of the year. How do they look from a volatility standpoint, from a positivity standpoint, if positive is an option in your opinion?
No, I think it absolutely is. Like I said at the beginning, I think you've gotten kind of that overhang cloud, whatever you want to call it, when it comes to the government shutdown out of the way. We just came off the back of earnings season. So companies report earnings every quarter. They did it in the month of October. It kind of drifts into November, where folks were reporting like double-digit earnings growth, which is impressive. But maybe what's even more impressive is that they were reporting double-digit like sales or top-line growth. Top line or sales growth isn't something that you can like monkey with. You can't, you can kind of fix earnings to some extent. But sales growth is something that like, hey, you're seeing people that are still buying things. So like you've got a pretty good tailwinds heading into the end of the year. You've seen efficiency pick up, productivity pick up. I mean, this AI trend that we've all been hearing about and talking about, like, is starting to make some progress when it comes to companies that are implementing it. I'm not going to sit here and tell you that it's, that's the sole driver of double digits earnings growth. But like you actually have a number of tailwinds in place with, like I said earlier, employed consumer, folks that are spending money. Now you have you got a Fed that's cutting rates, and they're not cutting rates at some massive pace because the economy's faltering. They're cutting rates to get back to their long-term kind of normal. I think the last 45 days of the year probably have, I would say minimal volatility. You probably have a market that continues to grind higher. I don't think you have any reason for some massive like spike higher. But I do think you have a market that goes higher into the end of the year, because a lot of those tailwinds have basically kind of evaporated. Now, as we get into 26, does the consumer, start to see challenges? Does the labor market maybe start to show some cracks? Absolutely, those are possibilities. But that's probably you're talking mid 2026 phenomenon. So I think between now and especially the end of the year, like you're set up pretty nicely.
Excellent. All right. Austin Fitch, Horizon Investments. Always a pleasure. Genuinely appreciate you.
Absolutely.
We'll do it again early in 2026. How about it?
Awesome. Hey, that sounds great, Lou. Appreciate the time. And as always, love being on with you.
Well, we'll do it again.
Cool. All right. See you guys.
Thanks.